Welcome back to this channel. This is Unfiltered Forex with me, Clement, and I'm back. I don't know if I will, but I'm back. So, in this video, I'm going to talk about something I have never talked about. I only mention it, but I'm going to talk about the interest rate differential between economies. All right, the interest rate differential. I'm sure if you're familiar to this channel and generally familiar to the finance world and economics, you know about interest rates and what they are and the usefulness. If you don't, there's a video you can check out. Anyway, now various economies they have different interest rates depending on their level of inflation and their level of unemployment, because that's the usually the main job of interest rates, to either tame inflation or to stimulate employment. So various economies they have different interest rates, and what interest rates do is they affect the demand for a currency. All right, so you can see there's a list here: world central banks and their current rates, and the next meeting and the last change. So currently, as you can see, the highest among these top G7 economies is the Federal Reserve. They have the highest rates among the G7 countries, and yeah, 5.5%. Okay, you can ignore Russia and China and Brazil. Yeah, Brazil is a small country, and Russia they use a fixed exchange rate regime. Yeah, I believe so. Fixed. Even China they also use a fixed one. So the Federal Reserve they have the highest rates among the economies that matter, 5.5%. This This means by default the dollar demand generally be more than demand for these other economies. Already on top of the fact that the dollar is the reserve currency of the world, now the interest rate being high creates a new demand for the dollars, in that because you need the dollars to take advantage of these high interest rates and invest in treasury yields. Yeah. If you haven't checked out that video, there's a video on government securities. You can check it out. Yeah, so European Central Bank 4.25%, Bank of England 5.25%, and Swiss National Bank 1.25, Reserve Bank of Australia 4.25, Bank of Canada 4.75, but they are expected to cut rates today. Today is July 24th. Yeah, in about an hour and a half. Yeah, that's when the latest monetary policy statement will be coming out, and they are expected to cut rates. Also, Reserve Bank of New Zealand, they have the same rates as the US, but this doesn't mean that now dollar and the New Zealand dollar are on the same level. They aren't. Among these major economies, Japan is usually a special case. Okay, so among these major economies, you can see last change here. So some economies have already started cutting rates. For example, this is the European Central Bank 4.25, and the last change was June 6th this year, and they cut the rate by 25 basis points. Another one is Swiss National Bank. Their latest meeting was June 20th this year, and they cut the rates by 25 basis points. And then June, yeah, Bank of Canada, they have also started cutting their rates. All right, so okay, also looking at Japan, them they decided to hike the rates on March 19th. Yeah, that's when they ended their negative interest rate policy and decided to hike the rates to this positive by 10 basis points. Previously, it was a negative. All right. I can even just show you because the chart is here. Yeah, you can see the interest rate. Now, this is the historical chart. If we just zoom in here, you can see for the past few years, this is the latest tightening cycle, and this is for the Fed, the Federal Reserve in the US. They began in 16th March 2022, and they kind of stopped hiking July 26th, 2023. That was the last rate hike. So this is a whole 1 year and some months of constantly hiking interest rates. Yeah, except for here when they delivered a pause, but they still hike the rates in the next meeting. So yeah, currently we are in a tightening cycle. Tightening cycle meaning the rates are going up. That's the tightening, right? So you can see this is for the Fed. They started in 2022. ECB, same story. They started in 2022 in July. In previously the rate was zero. Bank of England, same thing. They started raising rates. These guys actually started in 2021, yeah, after the rate being so low for quite some time. In 2021, they started hiking rates, and you can see this rates, this interest rate, this rate hike cycle has been a very aggressive one, not just by one central bank. No, even these other central banks, you can see the trajectory of hiking the rates and the speed was quite unprecedented, which of course is justified by the high levels of inflation we've seen for quite a while in various big economies. Okay, so talking about the Swiss National Bank, you can see them. Yeah, they also started in 2022, but mid 2022, because for these guys they only have 4 meetings in a year. All right, if you look at the Fed, they have several. I think 8 or 7, 8. I think, yeah. And but for the Swiss National Bank, the Switzerland economy, they only have 4 meetings in a year, right? And they started hiking the rates from they were initially negative, and yeah, so in June 2022, they hiked the rates by 50 basis points. This is a 50 basis point change, and then again by 75 basis points to bring it from the negative to 50 basis points, and then hike, another 50, another hike, another 50, and then one last rate hike, 25, and then they started cutting just this year. So yeah, you can see between 2022 to 2023, most economies were actually raising interest rates. Yeah, this is now the Reserve Bank of Australia. This is Australia's central bank. You can see from 2022 till 2023, end of 2023, they were hiking rates not as aggressively as the Fed and the ECB and the Bank of England, but they were. This is also something that can be considered an aggressive tightening cycle. Same with Bank of Canada. Yeah, 2022 until 2023, that's when they stopped hiking rates, and rates have been high. So you can see from this picture I'm trying to show you here, all of these economies, most of them, okay, all of them except Japan, they were hiking rates from 2022, some as early as 2021, up to 2023, around Q2 of 2023, some until Q4. So during this time, the rate differential was I don't want to say getting smaller, but anyway, let me get to that. Let me show you this one finally. This is Bank of England. No, Bank of Japan, sorry. And you can see since 2020, and in fact, it's since this is when 2016. Yeah, they've had negative rates since 2016. All the way until 2024, January 2024, they have had negative interest rates. So you can see this is an outlier. No other economy you've seen here among these other ones has has had negative rates, has had very low rates the period between 2021 and 2022, 2023 there, let alone negative. No, they were all hiking in their interest rates to deal with inflation, but Japan, they didn't have the inflation problem. And yeah, so they kept their rate constant because economic activity was still very weak. So yeah, uh-huh. So what am I going to tell you? When you see an outlier like Bank of Japan, all right, you can see all these top economies because these are the economies of the major currency pairs: Euro USD, GBP USD, USD CHF. That's a Switzerland CHF, Swiss franc, uh, Australian dollar versus USD, USD CAD, USD NZD or NZD USD rather, USD JPY, all these major currencies. These are the central banks, and this has been the interest rate. So you can see the Bank of Japan had the lowest rate for the longest time, while these other economies, they were hiking rates to levels never seen in decades. So that automatically makes the difference so big. Like Bank of New Zealand, their rate is 5, and Japan was at 0, negative in fact. All right, so the difference was already big. Same case with these other economies. So from the time these countries started hiking, because some of them were at 0, some of them were at 10 basis points, where Japan is right now. So from the time they started hiking up to when they stopped, that meant the rate differential had only been getting bigger and bigger. And what does that mean? That automatically creates more demand for these other currencies, but lesser demand for the Japanese yen. On the chart, like what you expect to see on the chart when you look at this, you expect to see a significant weakening of the yen between 2022, start of 2022, up to until mid um, end of 2023. Yeah, for those 2 years, you already expect to see a significant weakening of the yen because their interest rate has been so low, while the other economies, they have been hiking and hiking and hiking very aggressively. All right, so enough with the stories. Let's just look at the chart. Right, this is the cut. USD JPY. Let's start with this one. I'm looking at the weekly charts. All right, the weekly chart. Let me pick something clean. Yeah, this is better. I'm looking at the weekly chart, and you can see like yeah, this actually started in 2021, but yeah, you can see from 2021 up to present. This is just very recently, the previous month. The yen has been consistently weakening, except for a phase here. The yen has been consistently weakening against the dollar because of the difference in the interest rate alone. Even ignoring all the other factors, the difference in rates alone is enough for such a trend to be so consistent because it's only going up. And this is a weekly chart, it's only going up. And yeah, the reason, the rate differential. All right, so let's look at another economy. Like we've seen, what is that? Yeah, we've seen the Bank of Canada, not that one. Yeah, the Bank of England also have a very high interest rate, and the Bank of New Zealand. So you're going to check GBP, JPY, and see if there's a similar price action. So yeah, it's mostly the same. It's an uptrend showing a consistent weakening of the Japanese yen versus the pound. Again, same story because of that rate differential. Um, Look at another economy like using NZD, JPY. Yeah. You see the same story here, though the trend here has been quite not so clean. Of course, again, this is not just a difference in the interest rate, but rather a difference in the size of the economy. As you've seen, the USD JPY had a bigger uptrend, bigger and longer uptrend because of the difference in size of the two economies. And on top of that, the rate differential was so high. Yeah, but for this one, you can see the trend is not so clean because of difference in economies isn't all that much. Yeah, I haven't checked the GDP numbers, but yeah, you know, between New Zealand and Japan, the two economies, New Zealand isn't so big as compared to Japan. Anyway, the rate differential has been big. That's the thing that has fueled this uptrend. Yeah, you can see it's been weakening quite significantly over the past few weeks. Yeah, check that out later. Something else compared to the CHF. CHF, yeah, they also hiked, but they're now cutting. Yeah, there's the same story here. One one currency has been significantly weakening against the other over these past 2 years, 2022, 2023. You can see the uptrend was quite strong, and you can see it goes back as far back as early 2020. This is where it started to really start to go up and the gain momentum here in 2022. That's when the uptrend like kind of just got stronger. Of course, because one economy was hiking interest rates, the other one had a negative interest rate policy. So by default, that in itself, one currency becomes superior to the other, not just in the short term, but even in the long term. Because you can see, for example, this tightening cycle has been 2 years, and 2 years is a really long time when you are looking at such a chart. All right, because yeah. Anyway, that's it for this one. Something else I wanted now to talk about is that now there's a change, all right? Because as we have seen, some central banks are starting to cut the interest rate. For example, the Swiss National Bank, they are cutting. Yeah, the Swiss National Bank is cutting. They started cutting. Also, there's the Bank of Canada. They have started cutting. So at this time, the interest rate differential between what do you call it between these economies and something like the yen is getting smaller, all right? Because now they are also lowering interest rates and they will soon probably be at zero or near zero. So putting that into consideration, what you're going to want to do is compare one economy whose interest rate is likely to stay higher for longer and put that currency versus a currency that you think the interest rate is going to start falling quite aggressively. Like currently, we're talking about the Bank of Canada, right? They cut once, and we are expecting them to cut again, and promise more cuts on the way. So, of course, that's going to mean we might see a weakening of the Canadian dollar versus these other currencies. The Canadian dollar might be generally weaker when you compare the Canadian dollar versus the Australian dollar, or Canadian dollar versus New Zealand dollar, or Canadian dollar versus the pound, or Canadian dollar versus the euro. Simple reason, these other economies are like England. Yeah, these other interest rates are high, while them they are cutting with the promise of more rate cuts ahead. So as this differential gets bigger, the currency will get weaker. Currency with a smaller rate. All right. So that's what I would like you to take note of. So mhm, something else important I should highlight is that the relationship between these cross pairs is the one that's usually a more clean, what do you call it? A cleaner trend, right? There is a trend and it's clean. It's a clean one. You can trade that. Like we've seen the CHF. Wait, the chart. Yeah, like we've seen the CHF and the JPY. This is one very clean uptrend. But when you compare two economies like the euro and the US dollar, when you compare two economies like this, you can see the trend is not so clean. Been trading a lot. So yeah, when you compare these two countries, you can see the trend is not as clear as what you have seen on the previous pair. Yeah, simple reason is the rates differential alone is not so significant, and these countries, these countries, these economies, the dollar, for example, is more affected by interest rate expectations than by actual interest rates. All right. For example, here you're seeing the dollar is the highest rates among these major economies, but there is no clear trend when you go to the charts. Like when you compare the US dollar versus the ECB versus the euro, or US dollar versus the pound, there is no clear trend because the rate differential alone doesn't really affect price action to a large extent, unlike between the cross pairs. So what that means is these ones, these two mainly, yeah, their movements are highly affected by interest rate expectations. Like you can even see there's a Fed rate monitor tool here. This is the next meeting time, and majority of market participants are speculating whether the interest rate, where the Fed will leave the interest rate. All right. So yeah, currently 94% of market participants are projecting that the Fed is going to pause, another pause. They're not going to cut rates in the next meeting. Next meeting is in July 31st. That's next week. Yeah, that's next week on Thursday. So yeah, you can see now an expectation like this. This is what's going to actually now affect the currency, the dollar. The strength or weakness of the dollar in the short term is going to be affected by these interest rate expectations. Let me show you the table. Mm, yeah, this is the website. This is where you can check out the expectations and go to here probabilities. Now you can see the table. This is you can see these meeting dates, future expected meeting dates, and rather future scheduled meeting dates, and these are the expectations the market has of where interest rates will be in the next few meetings. So yeah, that's 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 why the US dollar is very volatile, because it's more affected by rate expectations than actual interest rates, you see. Okay, so that's it for this video. I don't think I have anything else to add. If you have a question, you can ask in the comments. I will be sure to check it out. You have a lovely week.